So let's continue with the first chapter of audit. We have left before the engagement topic and we have covered till the limitations of audit in the previous video. If you have not seen that video, the link is in the description. You can see it from there. And the link to all the lectures in this series, the playlist, is also in the description. You can download the notes from the link in the description. Now with that, let's start with today's topic, engagement. Now what is an engagement? A formal agreement between auditor and client under which the auditor agrees to provide auditing services. Now this is an agreement between auditor and client, the person whom he is auditing for, in which auditor agrees to provide auditing services. So this is an agreement. Now there are internal audit engagements and external audit engagements. Now what is the internal audit engagement? Now this is ALTD. It has its auditing team which audits internally. Basically these auditing team or these are the employees of ALTD. So this auditing team works under ALTD. It only audits within the scope of ALTD and within its financial statements. So it is an internal audit. As it is done by these employees or these persons who are connected with ALTD, then the degree of confidence of this report is not that high compared to a person outside or not associated with ALTD does the audit report. If an audit report is done by a person outside ALTD or not connected to ALTD, it is called an external audit. And what is the purpose of external audit? To enhance the degree of confidence of intended users of financial statements. As we have seen before, there are many users of financial statements like investors, creditors, debtors. Now let's move on to the next topic, benefits of audit. Now why audit is needed? Now first of all, it provides confidence, gives confidence to users of financial statements that the information they are relying upon is qualitative. So it gives the confidence that if the persons are making decisions on the basis of this report, this report is qualitative, this information is qualitative and they can rely upon it. Now the next is safeguarding the interest of shareholders. Now this safeguards the interest of shareholders as the auditor audits and examines all the financial statements and the shareholders can know where their investments are going or where their stake is going. C. Acts as a moral check on employees from committing frauds for fear of being discovered by audit. Now, this also acts as a moral check as employees are fearful that if they commit any fraud, they will be discovered. So this maintains a moral check on employees. And it is the outcome of exercise carried out by following auditing standards recognized globally. So all these audit procedures are done according to the auditing standards recognized globally, so it is more reliable because these standards are recognized globally and crafted with precaution. Now next is helpful to government authorities for determining tax liabilities. Now it is helpful to government authorities because they will know if the company is concealing any income or doing anything to reduce its tax liability through the financial statements, audited financial statements. If there is a fraud, they will know, and through the financial statements they can also determine the tax liability. Now let's move on to the next point. Now next is can be relied upon by creditors, bankers, lenders for making their credit decisions. Now as financial statements are audited the creditors or the bankers or lenders may have a good view of company's financial standing, so they can assess their decisions, credit decisions, if they should give loans or they should give credit to this company or not. Will this company be able to repay them or not? Now, next is detects frauds and errors, as the audit procedures detects frauds and errors through analyzing the financial statements. Now next is reviews existence of controls. It is useful for pointing out deficiencies. Now, as we have studied before, this control means internal controls, all the controls which are held or which are practiced for maintaining the accuracy of financial statements. These controls are crafted and made by company for accuracy of their financial statements. So if there are any deficiencies or any thing which is missing in this control, which is not operating properly, they can be pointed out by audit. Now next is audit is mandatory or voluntary. Now the question is audit mandatory or voluntary? Now audit is not always mandatory, always legally mandatory for some enterprises or some organizations. They may choose to get it, they may choose to voluntarily get their accounts audited because of the benefits of audit, like they increase their confidence of shareholders and their lenders. They can get their accounts voluntarily audited. Now who appoints an auditor? Now first of all, there are various points on this. Now first of all, normally the auditor is appointed by the owners. Owners means the members, shareholders, who appoint the auditor in AGM. AGM means annual general meeting. This is the meeting which is held once a year in a company. Next is Controller and Audit General of India, CAG, an independent constitutional authority. It appoints auditor for government companies. Now the CAG appoints auditors for government companies. Now in some cases the government may appoint auditor with some law or regulation, in accordance with some law and regulation. Now let's move on to the next topic. To whom report is submitted by an auditor? Now audit is done, audit report is made. Now whom should the auditor submit this report? In case of companies, the shareholders will take the report, or auditor will submit the report to shareholders. In case of firms, it may be the partners or the people connected with them. Now let's move on to the next page. Now first of all, assurance engagement. What is an assurance engagement? An engagement in which a practitioner expresses a conclusion designed to enhance the degree of confidence of the evaluation or measurement of subject matter against the criteria. Now let's break down this definition. First of all, there is a mention of practitioner who expresses a conclusion designed to enhance the degree of confidence. So we can take that practitioner is the auditor, and he expresses a conclusion or designed to enhance. Then this is audit report. Enhance the degree of confidence of evaluation or measurement of subject matter. Now, so what he evaluates or what he measures? Financial statements. So the subject matter can be the financial statements against criteria. Criteria means all the auditing standards. Now this means that the person providing the assurance is practitioner and he provides audit report on the basis of subject matter, means financial statements. Now let's see the elements of assurance engagement. First of all, three-party relationship. There is a practitioner, responsible party and intended users. Now first of all, practitioner. We can say the practitioner is auditor as a person who provides the assurance. So auditor provides assurance in audit engagement. Now responsible party. Who is the responsible party? The party responsible for preparation of subject matter. So this can be the company, because subject matter means financial statements. And who is responsible for preparation of financial statement? The company. Intended users. Now who are the intended users? The persons for whom an assurance report is prepared. So in case of companies, they can be shareholders or all the creditors and people connected with them. Let's move on to the next point. An appropriate subject matter. Now the subject matter should be appropriate, refers to the information to be examined by the practitioner. Subject matter, we can take subject matter as financial statements. Now suitable criteria. Now suitable criteria means there are some benchmarks used to evaluate subject matter, standards, guidance, laws, and some rules and regulations which are used to evaluate this subject matter, means the financial statements. Now the evidence. Sufficient and appropriate evidence. Now sufficient means relates to the quantity of evidence obtained by auditor. Now the auditor obtains sufficient evidence means he obtained required quantity, and appropriate means relates to quality of evidence obtained by the auditor. Not only he has to obtain the right amount of quantity, but the right amount of quality too. The evidence should be sufficient and appropriate, both quantitative and qualitative. Now next point, a written assurance report in appropriate form. Now the assurance report is a written assurance report which is the outcome of assurance engagement. Now this report is the outcome of assurance engagement. Let's move on to the next page. Now review. What is a review? Review is a limited assurance engagement. It provides lower level of assurance than audit. Now review is a limited assurance engagement. What is audit? Audit is a reasonable assurance engagement. Now audit is a reasonable assurance engagement and it provides high level of assurance. Now let's see the difference between audit and review. Now first of all, audit is a high level of assurance. Audit gives us a high level of assurance and review gives lower level of assurance than audit. Now as audit is a reasonable assurance engagement and review is a limited assurance engagement, they give different type of assurance. Now next is more procedures are required than review. Audit requires more procedures than review and review requires fewer procedures than audit. Means review, the work for review is less than audit, that's why it provides lower level of assurance. Now let's move on to the next topic, which is difference between reasonable assurance and limited assurance. Now first basis is level of assurance. Now first of all, reasonable assurance is a high level of assurance and limited assurance is a lower level of assurance than reasonable assurance. Now number of procedures. Reasonable assurance requires elaborate and extensive procedures. It requires more work than limited assurance. Limited assurance needs fewer work. And examples, we can take examples like audit engagement is an example of reasonable assurance and review engagement is example of limited assurance. Let's move on to the next page. Now this is a chart showing types of assurance engagements. Now first of all, reasonable assurance is audit, limited assurance is review. Now there are assurances, there are assurance engagement which are dealing with matters other than historical financial information. Historical financial information means financial statements and all the books of finance. So they don't deal with financial statements and all that. They deal with prospective financial information. What does prospective financial information means? It is like a forecast. It deals with the forecast. Or they deal with assurance regarding operation of controls. Controls meaning internal controls. Now let's see it in detail. Now first of all, prospective financial information. What is prospective financial information? Financial information based on assumptions about events that may occur in the future and possible actions by an entity. Now, as it is like a forecast, it is based on assumptions about the events that may occur in future. So it is talking about the future. So it is like a forecast or the possible actions uh, by an entity. And it provides moderate level of assurance. Now next is assurance regarding the design and operation of controls. Now all the controls which are operating in the organization, they examine all that and report on controls operating at an organization. All, if there are any deficiencies or anything they should improve in those controls, they will report about that. Now next page. So the qualities of an auditor. Now what all qualities should an auditor have? First, he should be tactful, cautious, firm, integrity. He should have integrity, discretion, judgment, patience, clear-headedness, and reliability. So all these qualities should be in an auditor. Now, there are various engagement and quality control standards. Now, first of all, for auditing, there are standards on auditing, SAs. For review engagement, there are standards on review engagement, SREs. For assurance engagements, there are standards on assurance engagement. For standards on related services, there are SRS. Now let's see these in detail. Now all the standards which are related to auditing are SAS, standards on auditing, which apply in review of historical financial information. Now for SREs, which apply in assurance engagement other than audit and review of historical financial information. Now next is standards on assurance engagement will apply in agreed upon procedures to information compilation, engagement and other related services engagements. All the information or procedures required that can be seen in SAEs. Standards on related services, SRS, which apply in agreed upon procedures to information compilation in compilation engagement and other related service engagements. Like we have talked before that some engagement are does not deal with the financial historical financial information. So that is this. Now these are the various types of various standards on auditing: SA 200, SA 230, SA 315, SA 500, SA 700, and all these are lists for SREs and SAEs, SRS. Now let's move on to the next topic, standards on audit control, SQCs. Now what is SQC? SQCs have been issued to establish standards and provide guidance regarding a firm's responsibilities for its system of quality control for the conduct of audit and review of historical financial information and for other assurance and related services engagement. Now what does this mean? These are the standards which are established to provide guidance for firms' responsibilities in the quality of conducting the audit or review of financial statements, historical financial information and some other related service engagement. So these are all the quality standards or the standards which are made for quality of assurance engagements. Now next topic is, why are standards needed? Now why are all these standards needed? First of all, to establish a benchmark that is at par at global practices. So there is a benchmark which is at par with the global practices. The quality of that engagement or quality of the work which is done on the basis of these standards will increase or will be enhanced. Now second is, improves quality of financial reporting, thereby helping users to make diligent decisions. As these all standards are followed, they improve quality of financial reporting, and the person or the users of financial statements can make diligent decisions or easy decisions. Now next is promote uniformity as the audit of the financial statement is carried out following these standards. Now as these standards are uniform, if various organizations are following these standards, then their accounts or their financial statements are comparable. They will be uniform. They will follow the same principles, same guidelines, then they will be comparable, they will be uniform. Now next is equip professional accountants with professional knowledge and skill. As these standards are at par with the global practices, they equip the professional accountants with professional knowledge. Now last is standards ensure audit quality. Now as these are very renowned and at par with the global practices, they ensure the quality of audit. Now the last is this note of this chapter. Duty of professional accountants to follow standards. If not followed, reason for departure would be stated in reports. Now if the accountant is not following any required accounting standard, then they should specify the reason for the departure or for not following that specific standard in the reports, in the stated reports. Now with this chapter is completed. So you can also check out our module question series. The link will be in the description. And you can give a like to this video and subscribe to our channel for more videos like this.